monitoring that as Grace works her way through.
Lovely. Okie dokie, Sam. So if you're okay for me to go ahead, I'm just going to jump straight in because we have 60 minutes and counting, 55 now. So we're going to try and cram as much of this in. We've just done the MO5 law. And so I'm thinking I'm going to be speaking at slightly lesser pace than I did at that. So for those of you who've joined us twice, thank you. And fair play to you if you're doing 2 books at once. So this is a little bit more straightforward in some contexts, but we're going to go heavily into certain areas of this book today. And for those of you who are doing my 6-week course at the moment as well, there'll be a few spoilers because we haven't got to some of these bits in a second. So the latter part of this session is maybe stuff that we haven't touched upon yet. So what I propose to do in the next hour is go through some of the overview of the market structure, which some of you will be familiar with already. It's just kind of remembering things and bringing them to the forefront of your mind again. Then I'm going to look at the general kind of the terms for the structure of the insurance industry. So I've basically plucked things that I think haven't been in previous books that I think might just be good to do as a standalone. So I'll show you those in a bit. Then we're going to do key terms for corporate governance. And then this is the horrible one. Some of you are going to go, key terms for accountancy. So not the super fun area that I hope for on a Thursday afternoon, but we'll get through it. And then very finally, I'm just going to finish on predominantly kind of relevant bodies and associations. So chapter 7 is very heavily involved in some of the accountancy bodies that you need to know, and then also some of the rating agencies we're going to look at as well. So hopefully this is a good kind of revision session if you've got it coming up very shortly. So first things first, I'm going to dive straight in. I'm going to take a couple of pauses if there are things in the chat that, and Sam will kind of voice them back to me if they're relevant to that particular slide. Otherwise, I'll tackle them at the end. So without further ado, let's just look at some of these parts of the market and the general structure already. So first and foremost, on my left-hand side, these are kind of more Lloyd's-based aspects. So just to remind you, we have Lloyd's as a marketplace. A lot of you have done CERT already, so you know all about that area. So it's a marketplace rather than an insurer. The only new term that M92 actually brings in about Lloyd's is they talk a little bit about the council and the corporation of Lloyd's being the franchisor. And then they talk about the syndicates being franchisees. So that's a new term that they've brought in for that particular section. Another kind of thing that's quite akin to the London market is that of P&I clubs, so protection and indemnity clubs, so kind of ship owners. So essentially, there's a little kind of section on the book just reminding you that they're there. Brokers have got quite a good mention in this area as well. There's a lot about distribution channels, which we'll talk a little bit about in a second, but essentially they talk a little bit about different types of brokers. So they talk about insurance intermediaries generally, Lloyd's brokers, people who can broke in Lloyd's but don't need Lloyd's membership. They just need what is called a TOBA, a Terms of Business Agreement. And so they talk a little bit around kind of the middleman and what they actually do in terms of their role. Then moving on to my coral row in the middle, companies. Now, some of you have probably heard me say this. If you have me before, you'll have heard me say this at least 5 times before. Companies in this book are split down mainly into proprietary companies and or limited liability companies that are owned by their shareholders, and mutual companies, which are owned by their policyholders. So they talk about proprietary companies being people like Aviva, RSA, and then they talk a little bit about mutual companies, NFU Mutual, anybody else who is kind of pooling risks for the benefit of their members. So if there's any surplus, tends to be that members get paid out from that surplus at the end of a year of account. Talking of pools, this section is about the state in general. So they talk about state provision of insurance. The two kind of main areas that they look at is something called flood re, which does exactly what it says on the tin, kind of provides reinsurance for any flood risks where traditional insurance wouldn't be sufficient. And also pool re, which is to do with terrorism. So again, it's more to do with property insurance in terms of terrorism, but again, trying to bridge that gap for anybody who's left uncompensated in those areas. On that final one in the middle row, we're just looking at captives. So just to remind you, think of captive, they talk about it in different books as being a non-parent subsidiary essentially think of it as your own kind of personal insurance company that you set up. So for example, if you're Marks and Spencer's, you could set up yourself a captive. You yourself are not an insurer, so you have a captive to basically pay premiums into that particular group that you have, and then any valid claims will come back out to the parent company. So the reason for having captives is kind of a couple of benefits to it. You can set them up in really tax efficient places like the Cayman Islands or Bermuda or wherever you want to go. And you can also have access to the reinsurance market through them. So for example, Marks and Spencer's wouldn't have access to a reinsurance company because it itself is not a company for insurance, but through their captive, they could actually do that. So there are lots of benefits to having a captive. You don't need to know too much about this, but you can also have a renter captive and various other kind of group captives. But for the purposes of this, just think of it as a pure captive that's your own personal insurance company. Then finally, I've mentioned already reinsurers. I'm just going to bring you up to speed again with some of the bits of the terminology on this. I think you're going to end the session with having a bit of an achy hand, so apologies, but make as many notes as you can as we go. Just kind of jotting it down will cement it further into your memory. So essentially we have reinsurers can be specialist reinsurance companies like Swiss Re or Munich Re, or they could just be general insurance companies that provide reinsurance. So they don't have to be specifically doing that. If I am AXA XL and I'm providing insurance to Chaucer, that would be referred to as inwards reinsurance. However, I will also have my own reinsurer, and that, if I'm at AXA XL, that would be an outwards reinsurance side of things. So just remember those two different terms. So it depends kind of what the chain is. But just thinking, if you picture an insured, which is an individual or a company or something like that, if they have insurance from a company, and then that company then gets reinsurance, the original insurer, remember, becomes the cedant, C-E-D-A-N-T, or the ceding office. And then it can go further and further, depending on how far you want to get down the line, where we have retrocession and things like that. So it's quite a lot of parties involved, but it's good to kind of get under your belt if you can. There's a lot of questions, the multiple choice in this kind of area, which is why I'm going through it again, just to make sure it's in your memory. Something that you might not have met before, unless you've done IF1 for your certificate level, is that of takaful companies. So if you remember, this is to do with Islamic law, which is under a law called Sharia law, and essentially traditional forms of insurance aren't permitted under that law. Primarily because we have a couple of words that I'm just going to mention now. Apologies for my pronunciation. We have gara, which is uncertainty. We have maisir, which is gambling. And we have riba, which means interest. All three of these things are not permitted under Islam. So therefore, a takaful insurance company is effectively like a mutual company where all of the members pool their risks together, and it's far more cooperative. It's much more guaranteeing each other. There's no kind of interest made. It's all very much community based. So we have that. We also have re-takaful, funnily enough, which is reinsurance of a takaful company. So it does get a little bit complex, but you don't need to know that. I'd say stick to the three things that I just mentioned there, and just know how takaful operates. That will be sufficient for the multiple choice exam. And then very finally, self-insurance, not to be concerned with non-insurance, so just simply not insuring yourself at all. Self-insurance, you're actively putting money aside, either in your own kind of self-insured retention or in another little kind of cordoned off part of your group, of your companies. So your BP is very famously provides for some aspects of its book self-insurance, which essentially looks at making sure that you've got funds there for a rainy day should there be something massive that insurers, it will be too fundamental for them to actually insure. Okay, good. All right, I'm going to pause there just in case Sam wants to ask me anything, but otherwise I will move on. So do shout if you have any questions within the chat that you want me to answer, but otherwise I'll just kind of move on to finalize this chapter 1. So again, I've just pulled, I know some of these words might be quite familiar to you already if you've read the book. I've just pulled some of the key aspects that don't really come or get mentioned in the certificate level. So first is, when they talk about distribution channels, they talk a little bit about going direct, to the actual insurance company, or indirect, so maybe going through a broker. And you also have kind of aggregators, things like that, so compare the market, go compare, all of these different kind of things. They also talk a little bit about retailers and affinity groups. If you did IF1 as opposed to LM1, they mention something called an introducer appointed representative, which is basically where you're queuing up in Tesco and you go, oh, okay, there's a leaflet there, Tesco Home Insurance or Tesco Car Insurance. They're providing like a white label for their brand, and as such, they get you through that distribution channel. Affinity groups kind of go hand in hand with this. An affinity group is a group with a shared interest, and it's formed on that basis. So everybody is in a common ground on that in that way. So for example, if you are a bunch of stamp collectors, maybe an insurer can sideline and get access to your business for insuring your valuable stamps or something like that. So you're looking at a shared common interest, and an affinity group, you're providing kind of collective insurance to them based on their needs. So staying with that top line, let's look at the difference between multinational and global. So essentially, these two areas are under the global perspective heading in chapter 1. So it talks about multinational as having a home base, not DIY company, but just a base where they tend to operate more. However, they are happily operating in lots of different areas, lots of different countries, lots of different regions. So multinational home base. I always think of multi-color charts and things like that, and then home base as the DIY. That's how I remember it. And then global, essentially, is like Lloyd's, where you've got a global brand and you intend to push that brand worldwide. So with Lloyd's, for example, you have a platform in Dubai, you have a platform in Singapore, in China, all of these various places, but you take that Lloyd's brand with you where you go. And then, looking at that bottom row, let's talk a little bit about growth before we leave chapter 1. So we're looking at organic growth versus non-organic growth. So organic growth is simply the company just growing by taking on, maybe more staff, getting more revenue, having a higher turnover, all of those things that you'd expect a company to do on that basis. Whereas non-organic growth tends to relate to things like mergers and acquisition, where very quickly you can grow overnight by forming a partnership with another company. So they distinguish between two different types of non-organic growth. One is called horizontal. That is typically where you've got something of a similar group and you're just trying to increase your market share. So as an example of that, the recent Marsh JLT merger is, I would refer to as horizontal non-organic growth, because they have the similar markets and there's an overlap. However, you can also have a vertical non-organic growth. So if you think of a production chain, this is where you're trying to get access to a market that you might not necessarily have access to. So a good example in the last few years would have been the Catlin takeover, so whereby XL took Catlin over, and then XL got taken over by AXA. And the whole reason behind that merger was so that XL as a company could get access to the Catlin syndicate, to the Lloyd's market. So that was what we would call vertical non-organic growth. Okay, so they're the 5 key terms that I've pulled out of chapter 1 that I don't think you would have necessarily met before. Let's head on in to a few of the other parts. So the ones that I'm going to go through in a second, they kind of go over chapters 2 and 3, because both of them are in relation to management of insurance business. So I've kind of crammed those all together. But again, I've tried to kind of cover off terms that maybe you might not have seen before, or maybe are quite unique to this book. So the first one, they talk a little bit about how to make sure that your business is doing as well as it can be, and how to measure and use measuring tools to make sure that you're hitting your targets and your objectives. So I've only included a few in this slide. There are lots of them. So just to reel them off, there's benchmarking, there's management by objectives. The ones that I've got on the slides, you've got critical success factors, which look at a SWOT analysis. So looking at your strengths, weaknesses, opportunities, and threats. And then you also have KPIs, which is your key performance indicators. And remember, these can be efforts orientated or results orientated. So it's all about the measurement of everything that you're putting into place. Then we move on to budgets, and this is quite a big chunk in the book actually. They talk a little bit about variance analysis, so essentially where you're kind of forecasting your budget, where you're looking at where the budget maybe hasn't quite been met. So you can have two different types. You can have favourable